About it in an instant audit. Kevin Kramer is with us this morning from West End Financial Advisors. Great to have you, Kevin, for the first time. Good morning. So, yeah, as Jenna says, the bids don't seem to be up to what the so-called market value would be for these assets. Somebody getting a pretty good deal on these AIG assets, do you think?
Yeah, absolutely. This is a real fire sale. It's a tremendous opportunity for somebody to come in, buy this on the cheap. It's pretty unfortunate, however, because for the most part, AIG is a very well-run company.
Right. So unfortunate for AIG, from AIG's point of view.
Yeah. But fortunately from whoever ends up being the high bidder here.
Well, we didn't get into exactly who the bidders are, but it looks like maybe a portion of them are private equity firms along with some other fund managers. There is an auction going off. There is some sort of battle for these products, even if it is lower. Is that a good sign for the market? Is there anything we can take from there, even if you're an average investor, as far as market activity goes?
I think there is a good sign here. We clearly need to work our way through all of these dilemmas, these toxic assets, these problems that have come upon us and are still with us. So to the extent that they're able to sell off one of their crown jewels, something that's been a well-run unit in AIG, I think this will augur well for other opportunities down the road and may create a floor or a basis from which other similar transactions take place.
Well, so as you understand it, what they're actually selling here, these asset management units, is pretty good stuff. In other words, the problems at AIG were in a completely different unit, right? So, I mean, whoever takes this over won't have the AIG name associated with it, right? So you can take it and run?
Absolutely. I mean, Hank Greenberg really is quite accurate in saying he built a well-run company, everything except the credit default swaps.
Which were only $1 trillion or so.
Right. Just a rounding error. But, you know, the insurance business, their asset management business, both very well-run, well-maintained, well-regulated. And, you know, those things
Would you bid, though? Would you bid if you were part of that?
Oh, absolutely.
Really?
It's a bargain.
Yeah.
You know, you're going to come in here and buy stuff on the cheap.
And you wonder if those prices go up a little bit because everybody sees it that way and they start bidding against each other and maybe the price does get up closer to market value.
I don't see it going up closer to market value. These are bottom feeders.
Right.
This is a great opportunity to come in again on the cheap and buy a good portfolio of assets and sit on it for a couple of years and realize some outsized returns here.
Good enough. Kevin Kramer with us all morning. Thank you, Kevin. Good to have you. All right, let's talk about General Motors here.
Be the play here. And maybe there's a different way to invest in this market. So what is that, Kevin?
Absolutely. West End Financial Advisors specializes in lending money in the franchise space. We lend to the top operators of the top brands, and we know these areas exceedingly well.
Okay, so if you know them well, what are some of the top areas? I mean, if you're looking at that, is it casual dining? Is it more fast food? Where's the balance?
Good question. We think of the restaurant industry as having three components: fine dining, casual dining, and QSR, quick service restaurants. The first two segments have really taken it on the chin. Consumers are obviously reining in their spending. They're going out less. But where they are going out more and where the lines are long are in quick service restaurants.
Okay, so QSR.
Quick service restaurants.
Which ones are the ones that you like? Because people look at these in the stock market, like the Yum brands, McDonald's, Burger King, for example. Is there one that you like more than others?
We like all the ones that you've just mentioned. National brands with big advertising budgets that bring traffic into the stores.
Now, some people would say playing in this kind of financing side is like playing in traffic, really. With the credit markets being what they are, you're going to lend money to businesses during this time that's really uncertain. Why is this the right play, you say?
Well, you know, one of the things we believe at West End is long-term financial security. So we're always looking for places to invest money where we can get consistent positive returns year over year. And the franchise space is an incredibly good place to do that. It's very recession resistant.
Okay, what's your success then?
Our success is tied to the fact that we go to the best operators and the best brands. We have deep subject area expertise, and we make smart loans that get paid back.
Aren't you a little bit worried, though? I mean, the climate is such that, you know, maybe you loan to somebody and then something just happens in the area, a big sector in that area loses their job, they're exposed to the job losses and everything that's going on in the economy. I mean, doesn't that make you nervous?
No. That's a good point. Michigan's a great example. Obviously, the auto industry has taken it on the chin, but the quick service restaurants they are doing just fine.
That is interesting. So do you own stocks, though? Do you own like a McDonald's stock?
We do not. We do not participate in the equity side of this. Rather, we lend money secured lending with mortgages tied to dirt and to buildings and to establishment value. So this protects our customers or our investors on the downside. If there is a problem, like you suggest, and it does happen, I've got recourse. If I'm in the stock market, I have no recourse if the value of that share goes down.
You're right. Dirt is for sure, no matter what, recession or not.
Exactly.
Kevin, thank you very much. It's an interesting way to kind of look at it. We forget about that. Thank you. We're going to be with Kevin also next hour. We have
President and CEO of West End Advisors, West End Financial Advisors, Kevin Kramer, who's been our guest all morning long. What do you make of that, Charles, that they're out to get the bank executives, according to Dick Parsons?
Well, there's absolutely no doubt about it. And, you know, I've been saying this from day one. It just coincided, obviously, with the presidential campaign, and it made such an easy target. And you know what I find, what I'm worried about more than anything else is what's going to happen down the road. Barney Frank has already introduced some legislation to make sure people who can't afford a mortgage never get one. You know, as much as the banks have been vilified, and even former President Bush, Hispanic home ownership rose dramatically during that time. Black home ownership rose dramatically during that time. I'm worried about what's going to happen in the future because I believe those two segments and a lot of other poor people in this country will never get a shot at owning a home.
You're reversing it too much in the other way.
Yeah, absolutely, and in large part because we're going to put so much pressure on banks that they won't be able to take those type of chances.
All right, and that brings us to the next point, Kevin, which we'll take a look at what Dick Parsons said here, is that, you know, when you assign blame, I don't know how important that is versus trying to find a solution to what we're in, but Parsons saying that, as you can see here, everybody participated in pumping up this balloon. Now the balloon has deflated. Everybody in reality has some part of the blame, but it's much more in the culture to find a villain and vilify the villain. Are there other villains besides banks that should be blamed for all this?
Well, I think he's spot on. Clearly, the regulatory agencies were very remiss in not exercising oversight and control to prevent the kind of excesses that did take place.
Right.
They all partied hardy. They all shared mightily on the upside, and it all came crashing down.
Not to say that Wall Street banks and everybody doesn't share in this.
Oh,
blame.
absolutely. But let's not forget Congress, though.
Right, that's what I'm saying. There's enough blame. If something this bad happens.
Absolutely.
Now, one thing, the AP, the Associated Press wrote a story here, Charles. This is actually in the story. Parsons' job, this is one thing about Dick Parsons, which is just worth pointing out. Parsons' job now is to help turn around the troubled banking giant, meaning Citigroup, as he did as CEO of Time Warner. Did we miss something in the news? Did Dick Parsons turn around Time Warner?
No.
Remember that? Right.
No.
All right. Anyway, back over to.
It's overall. What do you think? You said people are either in cash or in the fetal position. That's what you said to Connell and I before going off during break. It sounds like you're not thinking about a recovery anytime soon.
That's correct. You know, we're on the eve of the earnings season here. To me, it's analogous to sort of being, if you're retired in assisted living, will it be maintenance mode or rehab? I think we're going to see another period here, very somber earnings results, guidance being lowered across the board. And we're going to be in maintenance mode here for at least one, maybe two more quarters.
That's interesting because I also think of it, Charles, in the way that before this not little rally, this rally, the 20% rally began, we were saying there was the excuse to buy in here somewhere, and you wonder whether, you know, to Kevin's point and broader point, this is an excuse to sell this earnings season and give up those gains. Well,
I tell you what, if you were smart enough to buy on the lows and you have double-digit gains across the board, you have to be considering taking some off the table. You know, I don't know how many people really, truly believe that we've seen enough evidence that the worst is over or that we're turning. And also, I think you have to make the distinction between things not being as bad. You know, and that's where I have a problem with some of all the people who are rushing to call the bottom. Everyone wants to be famous. Everyone wants to call the bottom.
Right.
There's got to be a major distinction, though, about, okay, we lost 700,000 jobs one month and then 650 the next. That's still not good stuff. I don't know that it warrants the type of rally that we've seen. I say ride the wave, but be prepared to get off.
All right, ride the wave, be prepared to get off.
Good advice. Whether it's a segue or the stock market or making a segue at the end of the show.
Kevin, would you ride a segue?
Speaking of segues, I really, again, think people should consider getting out of the market and finding non-equity things to invest their money for now.
One example of a non-equity thing to invest in would be what?
Well, there's certain investment-grade corporate bonds. They're looking attractive.
Okay.
There's certain hedge funds, again, that focus in private lending and specialty finance that would be good. And those would be good areas. If you want consistent, positive, long-term returns and you want to get off the roller coaster, that's the place to go.
Good enough. Kevin Kramer, great to have you on.
Thank you.
And we'll have you on again soon, West End.